Friends, in the previous lecture, we were dealing with IND AS 16, part 1. And in that, we discussed about the initial measurement of property, plant and equipment as per IND AS 16. Now, we are going to learn about the subsequent measurement. Okay, subsequent measurement of PP. And when it comes to subsequent measurement, I had already told you there are two models in which the subsequent measurement can be done. One is cost model and the other one is a revaluation model. A revaluation model. Okay, cost model and revaluation model. Now, what is this cost model? In cost model, even at the time of subsequent measurement, okay, subsequent measurement means in the reporting date, the property, plant or equipment will be carried at its cost itself. Okay, it will be carried at cost itself. So, the assets PPE is always carried at its cost. So, cost forms the basis till its disposal or derecognition. Now, just that it is carried at cost is not sufficient. What you will have to do? You will have to depreciate it. Depreciation or amortization is mandatory. Okay. Now, how to depreciate it? The depreciation or amortization should be done over the useful life. Over the useful life. Okay, depreciation and all is something which is very, very common, and we all know about depreciation, the methods of depreciation and all, right? Now, over the useful life, and for which we have different methods of depreciation. Methods of depreciation. We have multiple methods, and the common includes what? SLM, straight line method, then WDV method. Okay, then you have the revenue based model, revenue based method, etc. Okay, various methods are there. Okay, now one thing which we have to keep in mind is, see, with effect from January 2016, okay, there was an amendment with effect from with effect from 1st January 2016, where this revenue based depreciation, the revenue based depreciation method is not, they deleted the option to provide the depreciation based on the revenue. Okay, so you can't use this method, revenue based method of depreciation, but for this item you can follow any other method, and commonly used is SLM, straight line method, or written down value method. Okay, now any change in depreciation method or any change in the method of depreciation, we have already seen that it is nothing but it is a change in the accounting policy. Change in depreciation method, okay, is what? Is change in accounting policy. Change in accounting policies, and we have already dealt about this change in accounting policies in days 8. Okay, now, so that is one thing. So change in depreciation method is change in accounting policies, whereas change in the residual value, okay, residual value, or change in what you call as the useful life, all these things does not constitute the change in accounting policy, rather it is change in accounting estimates. So this will be given retrospective adjustment, whereas this will be given only prospective change. We learned about this in days 8. Okay, now we know that the depreciation have to be charged to the profit or loss, statement of profit or loss. Okay, and the depreciation should commence not from the date on which it is actually used. It should start, or it should commence when depreciation to commence when the asset is available for use. Depreciation to commence from the date on which the asset is available for use. Available for use. Okay, you don't have to wait until it is actually put to use to charge the depreciation. Rather, once it is available for use, you have to start charging depreciation. So that is about the depreciation and cost model. Now we will have to see what do you mean by the revaluation model. Okay, so in the revaluation model, what do we do in revaluation model? The asset is revalued. Okay, asset is revalued to its fair value. Asset is revalued to its fair value. So here we don't state or we don't carry the asset at its cost. Rather, we have to revalue from the cost. We have to revalue it to the fair value, and the asset will be carried in the financial statements at the fair value. Now here one doubt which many of the accountants or many of the chartered accountants has is, see, if you are following a revaluation model, is it mandatory that we have to revalue the asset every year? What do you think? No. Okay, since because you are following a revaluation model, it does not mean that the revaluation have to be done every year. Okay, the revaluation can be done every year, or maybe once in 2 years, or once in 3 years, or 5 years, etc., depending upon the nature of the asset. Okay, so the frequency of revaluation may be decided based on the nature of assets. Nature of asset. So what do you mean by based on the nature of the asset? Okay, you will have to see what is the type of the asset and whether this asset is subject to, whether the asset or property, plant and equipment is subject to frequent fluctuation in the fair value. So if the nature of asset is such that its fair value keeps on fluctuating frequently, then your frequency of revaluation have to be shorter. If the asset is something whose fair value will keep on varying every year, then the frequency have to be what? 1 year. Okay, you can't, for such kind of assets, you can't have a periodicity of 5 years if you are using which model? Revaluation model. That is not permitted. If you opt a model, then that revaluation frequency have to be according to the frequency in fluctuation of the fair value. On the other hand, if the asset, the nature of the asset is such that the fair value of the asset will be subject to variations only maybe very rarely, or the fair value will change only over a period of 3 years or 5 years. Okay, that means only less significant changes in the fair value. If that is the case, you don't have to revalue it every year. You can even revalue it to 2 years or 3 years or even 5 years. So the nature of the asset is very important. Okay, so that is one point which you have to keep in mind, frequency of revaluation. Now another point which I want to bring into your attention is, now if you have decided to follow the revaluation model, okay, whether that company or that business entity, should it follow this revaluation model for all the assets, or for some assets they can follow revaluation model and for the other assets can they follow the cost model? Is that permitted? What do you think? Friends, here also the answer is revaluation model need not be applied for all the assets. You can have selected classes. Okay, for each class of assets you can have revaluation model or cost model as you like. Let's say for buildings you can have revaluation model, whereas for office furnitures you can have what? You can have the cost model, or for computers you can have the cost model. So depending upon the type of asset and your judgment about the change in the value, you can decide which of classes have to be carried at a revaluation model, which of classes have to be followed under the cost model. Okay, but once you decide a particular asset class, let's say building. Okay, if you take the building, you can't have, suppose you have 3 buildings, okay, building 1, building 2 and building 3. Okay, can you say that, okay, 1 and 2 I will fall under cost model and 3 I will fall under evaluation model? This is not permitted. This is not permitted. If you are following cost model for 1 and 2, third one is also should be in cost model. If you follow evaluation model for B3, then B1 and B2 also should be under revaluation model. So selective application of revaluation model within a class of asset is not permitted. Okay, so that's all about the revaluation model. Now, you know, revaluation model, the accounting is also something which we have learned earlier. Okay, the calculation of depreciation. Okay, now one question which I want to discuss here is, suppose you are revaluing. Okay, you are revaluing the assets. Do you think that those assets which has been revalued will be again subject to depreciation? Will be again subject to depreciation? What do you think? Friends, the answer is yes. Even the revalued assets have to be depreciated. Suppose you evaluate one building on, let's say, 31/3/2024. Okay, and the next revaluation happens on 31/3/2027 after 3 years. So in between you have 24, 25, 26, 27, right? Okay, now on all these days you have to depreciate it. You have to depreciate. So depreciation is required even when you follow what revaluation model. There is no other way. And the depreciation you have to adjust against the revaluation reserve as well as the profit or loss account, depending upon that, something which you all know, right? Okay, so friends, when it comes to you know, the revaluation surplus, okay, where you have to show this revaluation surplus, the revaluation surplus is something which needs to be taken to other comprehensive income. Okay, other comprehensive income or OCI. So the revaluation gain or revaluation surplus have to be taken under other comprehensive income, and this will be subject to what? Whether it will be OCI, R or NR. Which one will be this? This is OCI R. At the time of disposal, this will again come back to what? Your profit or loss. Okay, right. So that is another point which you have to keep in mind. Whenever there is a revaluation surplus, the revaluation reserve have to go to OCI. Okay, and there is a specific case, okay, where this revaluation surplus will not go to OCI, rather it will go to profit or loss. Okay, so the principle is like this: an increase in value of asset under revaluation model is always credited to OCI, and this will be credited as revaluation surplus under OCI. Okay, unless it represents a reversal of the revaluation decrease. Okay, reversal of a revaluation decrease of the same asset previously recognized an expense. In this case, the increase will be recognized in the profit or loss account. Okay, this is something which you have to keep in mind. I will give you an example over here. Okay, suppose, okay, on let's say 31/3/2025, okay, there was a building, its carrying amount was, let's say, 50 lakhs. 50 lakhs was the carrying amount. Now you decided, let's follow evaluation model for building. Okay, so here you estimated its fair value estimated. Okay, and the fair value could be higher than 50 lakhs or lower than 50 lakhs. So let me take two examples. Okay, the first one, it was 60 lakhs and this one 40, or let's say 35 lakh. Okay, 35 lakhs. Now here it is revaluation surplus, or you have revaluation loss or deficit. So here it is 10 lakhs and here it is 15 lakhs negative. What do you do with this 10 lakhs? This is taken to OCI, okay, as revaluation surplus. And what do you do with this 15 lakhs negative? This will be taken as expense in statement of profit or loss. Okay, so this you can't take it to revaluation surplus as a negative figure. You have to take it to the profit or loss. Now what happens next year? 31/3/2026. On 31/3/2026, again suppose you revalued. Okay, the periodicity of revaluation was 1 year. Periodicity of revaluation, let us say it is taken to be 1 year. So on 31/3/2026, again a revaluation happened, and the revalued fair value here, let us say from 60 it has gone down to 55 lakhs, or in this case from 35, let's say it has gone up to 45 lakhs. How will you treat the revaluation gain or loss? So here it is revaluation surplus or let's say loss. So here there is a loss of how much? 5 lakhs, and here you have a gain of 10 lakhs. So what do you do with this 5 lakhs? This 5 lakhs you have to adjust against the OCI. Okay, adjust against OCI, revaluation surplus. You reduce it. So net amount will be 10 lakhs minus 5 lakhs, 5 lakhs in the first case. And what about in the second case? Already we have taken this into what? Statement of profit or loss. It has not come to revaluation reserve. So this reversal of 10 lakhs, can you take it to revaluation reserve? No. You can't show it as revaluation reserve under OCI. Rather, this should be taken to what? It should be taken to statement of profit or loss. Statement of profit or loss. Now the same thing I am going to change a bit. Okay, here what you have already recognized is 15 lakhs in statement of profit or loss account. Okay, now let us say here instead of this, okay, the revalued amount was instead of 45, let's say it was 65 lakhs. If it was 65 lakhs, then what is the revaluation gain? 45, here 35, 65, so 30 lakhs is the total gain. How do you take this 30 lakhs? This has to be divided. This has to be divided into 2. Okay, to the extent of the loss which you have already recognized, that is 15 lakhs, it will be taken to statement of profit or loss, because it is reversal of the expense which you have already recognized. So it has to be taken to SOPL. And what about the balance 15 lakhs? This will come as OCI in the revaluation surplus. I hope that is clear to you. Okay, this is something which you have to keep in mind because you might be tested on this. Okay, clear. So this is the treatment of revaluation reserve when it comes to revaluation model. Now we will have to discuss about, have you heard about component accounting? Component accounting. This is a new concept which was introduced by IND AS 16, or I would say IFRS 16, and later it was taken to IND AS 16, and again now it is there in AS 10 also. So what is component accounting? Now any significant part or component which forms part of your what you call your plant or property or equipment have to be depreciated have to be separately accounted, and it has to be depreciated over a different useful life. Okay, I will give you an example. Let us take the case where a company purchased a military ship. Okay, there is a military ship. Okay, maybe it was purchased by Navy or any defense company for their use or for any other purpose. Now the total cost of this military ship, let us say, is let us take it as 500 crores. Cost was 500 crore. So it will fall under which category? It will fall under ship, the category of ship or vessels. And the useful life of this ship or vessel, let us say useful life. What is the useful life of this ship or vessel? Let us say it is 5 or 10 years. 10 years is the useful life. You can use this ship for 10 years. Okay, so in a normal practice, what we will do? We will capitalize this 500 crore and it will be depreciated over the useful life. So depreciated over 10 years. This is the normal practice. Now I am going to give you another example over here. Suppose this ship, okay, this ship has got some specialized war equipment or warfare equipments. Okay, let us say this is the ship and this constitute what? The warfare equipments. A portion of this is war equipments, maybe heavy tanks or anything. Now the total military ship is costing you 500 crores, whereas the ship part, okay, I am just drawing this for the purpose of your understanding. Don't assume that, okay, up to this is ship and after ship you have a protruded portion which is the warfare equipment. No, it will be embedded in that. But I am just trying to correlate it better with this diagram. So this part is the conventional ship and its value comes to around, let's say, 200 crores. Whereas this part is the warfare equipments, then latest technology, maybe radar and all those things, where the cost is around 300 crores. Okay, or even it could be 400 or 100, which are proportion, I would say. Okay, now if you see, okay, even though you can call it as a ship in total, a military ship, this has got two different components. One is the conventional ship, the other one is the war equipment. Okay, now if you see the useful life, the ship will have a useful life of, as you said, 10 years. But this warfare, it might get outdated after every 4 years. So India 16 says that if it is the scenario, okay, and this war equipment, if it forms a significant part here, so is it not a significant part? Yes, it is a significant part. If it forms a significant part, then this has to be treated as a separate component. Okay, this will be treated as a separate component, and what you will have to do, this has to be capitalized separately, capitalized as a separate PP, separate PP. And what about the amortization or depreciation? Can you follow the same depreciation usual life which is applicable for the ship over here? No, the depreciation should be provided over 4 years and not over 10 years. So this process of splitting a particular property, plant and equipment into different components is what is known as component accounting. Okay, so account, this is one component, this is another component, account these two components separately. I hope that is clear. Okay, so this is on component accounting. Now there is a special point on the capitalization, the account treatment of spare parts, standby or servicing equipments. Okay, spare part, then standby or servicing equipment. Okay, so what is this? Sometimes, whenever you purchase a machinery, okay, whenever you purchase a machinery, that machinery will come with some spare parts or some standby products like motors and all, or any servicing equipments, the equipments which have to be specially used for servicing. Okay, now the question is, can you capitalize this? Can you capitalize this standby, spare part or servicing equipment? The standard says that, see, these things can be capitalized in a PP only when they meet the definition of PP. Okay, so when it comes to spare part or standby equipments or servicing equipments, we have to see what? Whether the definition of PP or conditions for being a PP is met. Conditions are met. Okay, and here definition of PP is not met. Here what you have to do? The definitions are met. So you have to capitalize as per Ind AS 16. So this is PP. If the conditions are not met, then it becomes inventory. It becomes inventory as per Ind AS 2. Okay, so this is accounting of spare parts, standby and servicing equipments. Okay, so then that standard talks about the disposal of PP, but we all know what to do the accounting treatment when there is any disposal of PP. Okay, you have to remove the asset from the balance sheet on disposal, or when it is withdrawn from use. Okay, the moment you have discarded or you have removed a property, plant and equipment from its asset, then you have to de-recognize the asset. And if that asset is held for sale, then it becomes non-current assets held for sale. Or if it is disposed of, then you have to recognize the loss or gain on such disposal. If it is sold, then the loss or gain on disposal have to be recognized, and this depends upon the difference between the carrying amount at the time of disposal and the amount, the proceeds of the disposal. Okay, what will be the difference between the carrying amount and the proceeds of disposal? If it is positive, profit or gain on disposal, or if it is negative, loss on disposal. Okay, then if a revalued asset is disposed of, any revaluation surplus that may be transferred directly to the retained assets. Okay, so if there is a revalued asset which is disposed, if you have any retained assets, if you have any revaluation reserves which is pending, revaluation surplus which is pending, what do you have to do? You have to transfer it to retained assets. Okay, don't transfer it or don't route it through the profit or loss. Okay, so any OCI created on revaluation is OCI NR. Friends, I think in the previous lecture I wrongly told it as OCI R. It is not OCI R, it is OCI NR. It cannot be reclassified or it cannot be routed back to the SOPL, statement of profit or loss. Rather, it will be transferred to what? Transfer to reserves directly. From OCIs, you have to transfer it to the retained earnings directly. Okay, so that's all about disposal. Then we will have to also talk about the disclosures. There are lots of disclosure requirements. You have to explain what are the measurement bases used in determining the gross carrying amount. Then depreciation methods used have to be disclosed. Then useful lives or the depreciation rates used, that have to be explained. Then the gross carrying amount and the accumulated depreciation at the beginning as well as end of the period have to be given as a reconciliation. Then again they say that a reconciliation of the carrying amount at the beginning of and the end of the period, showing all the additions, then disposals, then assets acquired through acquisitions, business compositions, then changes resulting from revaluation, then impairment loss, then exchange rate depreciation. All these things have to be shown separately and specifically in the what you call as the PPE schedule, the property, plant and equipment schedule. So if you see the financial statements of any listed entities or maybe the entities which you are auditing also, the PPE schedule will be a longer one and it will have various specific columns to say what is whether the asset is acquired through combination, business combination or merger acquisition, or is there any revaluation changes. All those things will be given. Okay, now another specific point which you have to keep in or which we have to disclose in the financial statements is the existence of any restrictions on title, okay, or the information on the PPE pledged as securities for liabilities. Okay, now suppose you are holding a property, plant and equipment, but if you have any restrictions on the title, sometimes you might have purchased some land from the government for setting up a factory. The government, while allotting the land, told that okay, you can't transfer this land. Okay, you can use it but you can't transfer. So there is a transfer restriction. If there is a transfer restriction, that has to be disclosed. Okay, now sometimes these assets may be pledged as a security for loans or liabilities, that also have to be mentioned or disclosed. Okay, now another disclosure is on the contractual commitments for the acquisition of PP. Earlier we used to call it as capital commitments. Now it is not capital commitments, it is contractual commitments. You have given a commitment to purchase or acquire, to construct some property, plant and equipment, even though you have not actually done. If there is a commitment, that have to be disclosed. You don't have to account it, but you have to disclose it. So friends, I think I have touched upon almost all the areas. I have given it as a summary of Ind AS 16, where we touched upon the recognition and measurement criteria, then the meaning of PPE we took, then the initial recognition, as well as the criteria and initial recognition, initial measurement criteria, okay, that we discussed, cost model, and what all things are included in the cost that we saw. Okay, then subsequent measurement. In subsequent measurement, we discussed what is cost model, what is revaluation model, then the accounting of revaluation model also we discussed. Okay, then we came to what the special points like component accounting. Then we also discussed about the accounting of spare parts, standby assets, then servicing equipments, then what to do when an asset is disposed of. Okay, then the disclosure requirements. So with this, Ind AS 16 is over, and we will move to the next standard in the next lecture. Thank you.